Good evening, members. I have two announcements to make. We have scheduled a GCC summit on 12th and 13th of December. Kindly register for that, as well as we have intensive sessions on 2025 Income Tax Act this Saturday, coming Saturday, and the next Saturday at APS College of Commerce. Please do register for it and make use of those sessions. Yeah. Members, I welcome you all on behalf of the Management Committee of the Bangalore branch for this study circle meeting. I request Chairman, Bangalore branch, Manjunath Amritsar, to please escort the speaker for the day and greet him with the forum today. Members, I have a privilege to introduce our today's speaker, who is speaking on non-resident taxation other than GAT and TP under the Income Tax Act, New Income Tax Act 2025. Amongst us, we have to speak on this K. PRASANNA, Chartered Accountant. I'd like to briefly introduce K. PRASANNA. K. PRASANNA is a Chartered Accountant and Commerce graduate with over 14 years of experience in corporate and international taxation, as well as transfer pricing. PRASANNA has extensively advised clients on inbound and outbound structuring, holding jurisdictions, and business model evaluations. He also has extensive experience handling corporate litigations. He won the FIT Fellowship Scheme for the Foundation of International Taxation Tax for 2018 and 2019. He is also a regular speaker at the study circle meeting of ICAI, IFA, Bombay Chartered Accountants Society, and CTC. He contributed articles on contemporary issues to various professional journals, joint feature contributor in the journal published by the Bombay Chartered Accountants Society. He has contributed to the book on demystifying session 194R published by the Tax Sutra and CTC. With this brief introduction, we present before you K. PRASANNA.
Good evening, members. I have one announcement to make. This Friday, 28 November 2025, in the same hall, we have one day training program for you becoming peer reviewers. Those who have already done the peer reviewer that certification course, to renew, you can attend this particular program. And those who want to become peer reviewers for the first time, you also can register and then attend for this program. This is on Friday, 28th of November, a couple of days later. Okay? Day after tomorrow, yeah. Okay? Kindly register and then attend. Make use of it. Thank you. Over to you, sir.
Good evening, I thank the Bangalore SARC for giving me this opportunity. I also thank Shivan and Nair for recommending my name for this session. So I have a humongous task on covering non-resident related provisions under the Income Tax Act 2025, barring GAR and transfer pricing. Because all of us, if you look at the moment a non-resident taxation comes, our mind always goes to royalty, FTS, permanent establishment, and most likely a transfer pricing. So therefore, if you have thoughts that, okay, these are the aspects that I am going to cover today, I am not going to cover these aspects, but we will briefly touch upon some fundamentals aspect of it, because some of the other sections of non-resident provisions dealing with royalty, FTS are coming as part of your presumptive taxation or as part of special rates of taxation. Like how we have section 44DA, if a current 1961 regime. Parallelly, if you look at this regime must be shifted to a different section. You have royalties and FTS intertwined. Likewise, 150A, which provides for rate of taxation for certain specific income streams, most likely a passive income streams. There also we touch upon the royalties or FTS aspect, but we will not get into the controversy surrounding what is constituting royalty and what is constituting FTS. That we will park it aside because the existing controversy under 1961 Act going to continue even in 2025, especially now that explanation has been moved as part of the subsections. So as far if you look at in current Act 916, you have explanation 3, 4, 5, 6 talks about computer softwares, process royalty, equipment royalty. Now all these explanations are coming as part of a subsection now. So how those going to interact and intersect, I think it's been covered in the subsequent sessions as part of the overall of the Income Tax Act. So therefore for the time being I will only confine myself to some of the key provisions of non-resident taxations. Now before we actually delve upon some of the critical provisions, I thought we will cover some of the fundamentals just to brush up once again, and then we move on to the core impacts of non-resident provisions. If you look at similar to the existing 1961 Act, the current 2025 Act, Section 5 deals with the scope of total income and it bifurcates between the resident, not ordinary resident and non-resident. If one were to look at on the right side of the table, with regard to residents, you have accrual arising in India or outside India is anyway taxable for a resident. Receipt or deemed to be received is taxable for a resident. Whereas when it comes to non-resident, accrual or arisal in India is taxable. Receipt or deemed to be received in India is taxable. Not for not ordinary resident is also exactly same, except for some slight change. If you look at in the footnote there, if any income or accrual outside India, but if the not ordinary resident were to control the business or profession in India, then to that extent, the scope of a not ordinary resident is being increased. Likewise, the charge if you look at is always on the total income, not on the scope of total income. Scope of total income is given in section 5. If one were to look at section 2(108) under the new act, which defines total income. It says total income as computed under or as laid out under section 5. So the purpose of section 5 is with regard to each chapters of income, what constitutes an income and then it aggregates. So essentially it is an aggregation function that is done by section 5. So once it passes the test of section 5, it satisfies income. So therefore your charge is created under total income. There are occasions where sometimes if you look at there may not be accrual or arisal on a particular year. But Act do create a fiction to create a charge. Say for example, section 38, which I quoted here, which is parallel with section 41(1), where waiver of any liabilities in respect of which in the earlier years I have claimed a deduction. But current year, those liabilities are no longer payable. If I have already claimed a revenue expenditure, then 41(1), now the current provision 38 says that has to be offered in the year of write back. So if you look at in the year of write back, there is no accrual or arisal as such if you look at by section 5. But Act creates a fiction. So to this extent, the scope has been expanded by other provisions but not by section 5. Likewise, section 71, which is parallel with section 47A of the existing Act. Withdrawal of capital gains. So there are certain transactions that are not regarded as a transfer. Say for example, any transfer of a capital asset from a holding company towards wholly owned subsidiary, which is an Indian company. In this case, subject to certain conditions, this transaction is not regarded as a transfer. Now, the existing section 47A says, this holding and subsidiary relationship must to be continued for a period of 8 years. So therefore, there cannot be any dilution in the 100% stake. So if there is any dilution, then 47A will say that whatever capital gains that I have exempted by virtue of section 47, current regime, the new regime, it is section 70. It says I am going to withdraw that and it will be taxed in the year of the original transfer of the capital asset. So therefore, in the year of withdrawal, if you look at, there is no accrual or appraisal, neither a receipt, but acts creates a fiction. So these are the occasions where some of this provisions where act is creating a fiction, by virtue of it a charge is being created, so it gets added. Although it never part of your section 5. But it still gets taxed because of the charge that is being provided at some other sections. Now if you look at some other provisions where charge, if you look at section 4, whether it is under the 1961 Act or 2025 Act, it is a charge on the income, which is for the previous year. Now it is a tax year. Now there, if you look at, a tax year is being defined as 1st April of the relevant assessment year till 31st March. Now if you look at some of these provisions, tax year can be curtailed. Say for example, current regime section 172, where in the course of a shipping income, occasional shipping income, which we will deal with it in later in a detailed manner. There if you look at, in a temporary basis, if their foreign company ships were coming into India and they were to earn some freight income, which is occasional in nature, they don't actually carry on the business on a regular basis, but occasionally they come to India, but they pick up some freight and then they earn this income. Then there is an obligation on the master of the ship to file the return at the time of the ship being leaving. So therefore, there section 172 will override section 4, because there it says a charge could be created for a shorter duration by virtue of a specific provision. Likewise, you have section 370 in the new income tax, which says that if anyone leaving India, then up to the point of leaving India, they can file their return of income. Practically, there are issues. If you go and file a online form, it will never permit you, because form gets notified only after the end of assessment years. But these are some of the provisions where existed at the time of we filing a manual return. So at that point in time, it was very much possible. So there are some exceptions to section 4, which has been specifically provided under the Act. Now if you look at section 5, it deals with 3 aspects: timing, place and person. It disregards source. Whatever may be the source, it is irrelevant, but all it talks about place, because approval it talks about in India or outside India, receipt also in India or outside India. So it talks about a location. Timing also during the previous year is what it refers to. So therefore it talks about timing as well. And person, obviously, because the bifurcation has happened between a resident, not ordinary resident, or a non-resident. So these are some fundamental aspects of section 5. And if you look at, it also yields to section 159, where an Indian government entered into a tax treaty with some other country. If those provisions were much more beneficial, then to the extent section 5 should yield to section 159, the current section 90 regime. So this is just about section 5. Now quickly touch upon the residential status. In case of a citizen of India or a person of Indian origin, whether he is visiting India or leaving for the purpose of employment, if if you look at the period of stay, there are twin conditions, but that twin condition has been curtailed in case of a person who is leaving for employment. So 182 days or more is the criteria, and then if he is satisfied, he becomes a resident. But to check whether he is an ordinary resident or not ordinary residents, we have to look at one more condition, whether 2 out of 10 financial years he is a resident. Otherwise, he should be a non-resident for 9 financial years or stay in India for more than 729 days over the last 7 years. If he satisfies these 2 conditions, he will become an ordinary resident. If he satisfies either of the conditions, he will become not ordinary resident. Of course, there is some drafting error in the Income Tax Act, or some sort of a creates an issue when we read this particular provision. I will read the relevant part of the provision. So it says, if you look at section 6 subsection 3, provisions of this subsection 2b shall not apply in case of an individual who is a citizen of India and leaves India in any tax year. So therefore, this is a case where our explanation 1a, which talks about in case of a citizen of India or a member of cruise ship, if he leaves India for the purpose of employment, whether this 182 days, sorry, rather 60 days is cut short into 182 days. Therefore, essentially 182 days is the only criteria. And there was a controversy even in the existing regime whether this particular benefit of leaving employment is applicable only for that particular year when he leaves employment, or it applies for every year. And there are divergent jurisprudence on this. In one case, I said it applies for every year, whereas most of the jurisprudence, including that of the Karnataka High Court, has clarified that it applies only in the year of he leaving for employment. But unfortunately, if you look at in 6.3, it uses the word any tax year instead of for that tax year. So therefore, this may cause some issue to argue that it applies to every year whenever I move out of India for the purpose of employment, or it applies for every year once if I move out, then I perpetually be entitled for this 182 is a point of interpretation that may come in. Likewise, a similar mistake is there in subsection 4 also, when a person visiting India, there also it uses the language in subclause B, any tax year instead of for that relevant year. This issue of that relevant to that year was discussed even in that explanation 1C, whereas after the any year it uses the language for that year. So therefore the courts have interpreted that because the language is used for that year, you have to see these conditions for that particular year alone. It cannot be applied perpetually. Unfortunately, the language, this could cause little trouble when it comes to an interpretation. And again, if you look at Indian income more than 15 lakhs, in case of a person visiting India, instead of 60 days with 365 days, 60 days is getting replaced with 120 days in case of I am having an Indian income more than 15 lakhs. If it is less than 15 lakhs, then it is only an 182 days criteria for it. This is a case where our 61A, current existing 61A, is being introduced in the form of a 67, where a small change in the drafting is notwithstanding versus irrespective of. I think there is one good amount of discussion is going to happen, so therefore I have been told not to get into these sort of an interpretation, because other study circles there is a specific focused session on this interpretation issues. So therefore I am not getting into this conundrum of notwithstanding or irrespective. But if you look at, it says this is mainly to address people who have significant income elsewhere, but they are not paying taxes either in India or in other country. So therefore, when they introduced this provision in 2020 under the existing Act in 618, they used the language stateless persons, especially targeting those people in Middle East because they have amassed significant wealth. And one more aspect which they wanted to target is mainly because they have been coming into India, and from India they have been controlling some operations. So therefore, Act has decided that I don't want to grant you undue benefits. Now I want to bring in provisions where if you are a citizen of India and if you are having an income from Indian sources more than 15 lakhs, then I want to target you in certain situations. The situations where if you are not liable to tax in any other country by virtue of domicile, residence or any other criteria of similar nature, then I will treat you as a resident. Then subsequently they are, based on representations made, they are not treating them as an ordinary resident but as a not ordinary residents. But the issue will come is if you, the moment you become a not ordinary residents, there are certain benefits that are available for you may not be applicable. Say for example, some specific regimes which will give you a lower rates under capital gains. If you are a non-resident, there are certain specific regimes that are available which we will deal with it in a while. Those kind of a regime you will not be available. Then the possibility of you availing a tax treaty will also come into question. So therefore, to target those people, if you look at those stateless income people, could be people who are holding golden passport schemes, high net worth individuals. There is a post of COVID, there is a lot of visas that has been issued by several GCCs countries as well as some of the countries in European Union. Say for example, Ecuador, Portugal, you have to pay a significant deposits to the government for which you have to get a golden visas in the respective countries where they don't have significant taxes. This could have some bit of issue from a computational point of view. So because it uses the word total income exceeding 15 lakhs. Now if you look at section 5, my total income is determined based on I being a resident or a non-resident. So the existing issue of first I have to identify the residential status, then go on to determine total income, or first keeping aside the residential status, how do I determine the total income? This continues even in the current regime as well. It has not been addressed so far. But practically what we generally do is, whether 6-7 applies for me or not, I will only look at my Indian income. If my Indian income, say for example, I earn a significant interest or dividends, which is anyway more than 15 lakhs, then at the best I would practically apply, okay, this is my Indian income which is more than 15 lakhs, so therefore I will look at this particular provisions versus the other countries' taxability to arrive at treaty related aspects. This issue will come morely in a situation where if I have a limited interest income, but I have a substantial capital gain, say for example, gains from mutual funds. Then in that particular situation, if you look at, while the gains from mutual fund may be an Indian income, but say for example, if I were to be regarded as a resident of Dubai, then under the treaty, the right to tax the mutual fund is vested only in the country where the person is a resident. So if I were to prove that I am a resident of UAE, then India does not have a right to tax. So therefore, in these sort of circumstances, this could pose some challenges. If I have other income, say dividend or interest, which is anyway more than 15 lakhs, I will not have any trouble. But if I were to include other incomes like capital gains, then Only because of that particular income, my limit is exceeding 15 lakhs. This could pose some serious challenges with regard to the circular efforts. This is quickly to touch upon the existing 6.3, where the residential status of a company is being determined. A company is said to be resident in India if it is an Indian company. Indian company has been specifically defined. So therefore, in case of an Indian company, I don't have a challenge. Only in case of a company which is other than Indian company, could be a foreign company, then this particular issue of test of residency will come, where place of effective management I have to look at, and similar to the existing provision in 6.3, they have defined place of effective management means the place where management and commercial decisions are necessary for conduct of business of an entity or all are in substances made. Currently there is a controversy in the existing regime because the power to frame rules for the purpose of POEM were never guaranteed under the section 293, which empowers the CBDT to define the guidelines. But that particular power has not been granted either under section 6 nor under the 293. So therefore, whether the question of guidelines that they have issued will be valid or not, so far it's never been challenged. At the same time, they have also issued a existing circular where they have exempted or where they have given a guarantee that I will not apply this POEM test for those companies that are having a turnover of up to 50 crores. So up to 50 crores, they have said, I don't want to apply this POEM test. So only in those cases, in excess of 50 crores of turnover, they intend to apply this. So by applying the General Clauses Act, there is a specific provisions where if the existing provisions were brought in under a different form, then whatever the circulars or notifications that are issued as part of the existing regime can continue to be applied. Courts have also applied those propositions. So therefore, in case any new guidelines they have not issued, the existing circular which are issued under 6.2 can also be borrowed here as well. Section 9, more from a fiction created for shifting the place of approval. It cannot make a particular income accrue. In case of income has already been accrued in India, then the role of section 9 will not come into picture. This is just a chart summarizing the existing section 9. If you look at, remains the same except for some changes in the order of this section, because many of the explanations have moved into a subsection, and there are some changes that are there as part of this section. I think Padam sir and Chaitanya sir is going to address on the section 9 aspect, so therefore I will not speak much about this. So if you look at the overall structures, remain the same with regard to the existing, but minute wordings changes have happened. Say for example, in case of a business connection, the through or from is being confined only to business connection, property or assets. The word through was used only for transfer of capital asset, whereas in the new regime, they have used through or from for all the 4 subclauses. And then there is a change in order of the independent agency versus dependent agency, which is causing some issue in the interpretations. Now, getting into the core aspect in respect of which I am supposed to speak today, which is on the taxation of non-residents. Some of these provisions are asserted even in the existing regime. Now it has become more even asserted because of the way in which section 10 has been shifted into various schedules. And corresponding TDS also, if you look at, they have converged all the 194 provisions and 195 provisions in the form of a table. And the table is also bifurcated into 4 parts. One particular table talks about residents, another particular table talks about non-resident. There is one more table which talks about the exemption limits. Say for example, currently you have 194C, there are some basic threshold limits are there, 30,000, 50,000. Those limits are moved into a separate table, and you have the fourth table in the form of a TCS. So therefore one has to look at all the 4 tables to arrive at what is the rate for a particular transaction. And at the same time one has to look at each of the provisions read with relevant schedule along with the note number of that particular schedule to look at what is the taxability. Do I have a taxability situation or do I have an exemption situation, and then connect with this tables to arrive at the rates in force. Now this is this is a situation where you have presumptive taxation in the form of section 44B series, where for different activities you have a certain presumptive rates. Now all these presumptive rates, close to 6 sections, were moved into one single section, section 61, and they have given it in the form of a table. That what is the eligible activity and what is the eligible income that I am, or what is the presumptive income that I am supposed to pay taxes. And at the end of the table they have given some criteria as to whether these are all mandatory provisions or whether these are all provisions that are choice, optional. Let's say if I don't want to go with the presumptive taxation, then what should I do? Either two, if you look at each were as part of a different sections. Now we will look at it in different sections, then how it has been presented in section 61 to put it in the form of a summary. This is a case of a non-resident engaged in the business of operating of ships other than the cruise ships. Because cruise ships you have a specific rate as compared to this. Presumptive tax rate is only 7.5% of the gross receipts. The gross receipts consist of amount paid or payable, whether in India or out of India, in respect of carriage of passengers, livestock, mails or goods, shipped at any port in India. So this is talking about an export freight. And then amount received or deemed to be received in India on behalf of a necessity on account of carriage of goods shipped at any port outside India. Now for the purpose of computing what is the total receipts, I have to include handling charges, demurrage charges or any other charges that are similar in nature. And it overrides normal computation. So the normal computation of section 26 to 54, the existing section 28 to 43. If I have equated, it is 26 to 54. So therefore it is mandatory provisions. I don't have a choice. Keep this for a moment. When we discuss 172, this has some interplay with this particular provisions. Then you have a second set of category of non-resident which are engaged in the provisions of services, facilities in connection with supplying a plant and machinery to be used in extraction or production of mineral oils. Here the presumptive rate is 10%. Likewise, amount paid or payable in or out of India in respect of mineral oils in India or outside India. So therefore, you aggregate both, apply 10%. This needs to be your PGBP. So the 10% will become like how we have 44 AD, AD or AD. So you have this presumptive taxation. Here, this particular provision is not mandatory. In case if you feel, okay, my actual profit is lesser than this deemed profit, then I am obligated to maintain books of accounts and get this audited, and then I can find the lower profits. If you look at the existing provision of 44BB, there is a specific subsection which permits the assessing officer to assess this income. However, that particular language is not being specifically used, but anyway I have to file a return of income, obviously if it is selected for scrutiny under the null provision. So therefore not mentioning of a specific assessment under the relevant subsection is not a issue is what my view is. Now third set of categories, non-residents that are operating in the business of operation of aircraft. Here the presumptive rate is 5% and these are mandatory provisions. I don't have any choice to offer lower incomes. There are some amount of representation that were made in the joint public parliament committee with regard to the reduction or giving an option to some of these provisions, because after COVID scenarios, there were, if you look at during the year of COVID, the operation of aircraft or ships had significant drop in the revenue because of productions not being made, and there is a more significant reduction in the movement of. But after COVID, there were significant increase in revenue because of people charging premium fee for movement of goods. If you look at the recent case, then there is again a dip in profit. So therefore, there were representations that were being made to enable these non-residents to offer a lower income. Unfortunately, that never been addressed upon. They have said any change in the provisions will tantamount to a policy change. So therefore, the role of the committee in drafting the bill is not to make a policy level changes. So therefore, they dropped that particular idea. Now this 10% is for business of civil construction or business or erection of plant or machinery in respect of the turnkey power projects approved by the central government. If any of your project is not approved by the central government, then you may not fall under this. You may fall under the normal business provisions, where if you have a permanent establishment, then you will end up having a taxation. Now the rate of presumptive tax is 10%. It is not a mandatory provision, so therefore if your profit is lower, then you are obligated to maintain books of accounts and get this audited. Now fifth category is what introduced in 2024 Finance Act, which was introduced in the Income Tax Act 2025 as well. This is a case of operation of cruise ships. So in the first item we saw in the operations of a normal ship. This is specific to a cruise ship, subject to certain conditions which they will prescribe, yet to be prescribed. The presumptive rates is 20%. And there is an interlinked deductions that are available for non-residents, which are leasing out cruise ships to those foreign companies which are operating cruise ship operations in India. So therefore, that lease part is also being exempted, which we will look at in a while. I'm just highlighting so that when we deal with that provision, we can connect with this particular provision, and it overrides normal computation. So therefore, this is also a mandatory provisions. Now, sixth is the category where introduced in 2025 budget, where based on the representations from NITI, they have introduced non-residents which are providing technological service for the purpose of electronic manufacturing of goods or article. So, if any non-residents that are rendering any services, then to the extent they may offer loss basis of taxation. And if you look at, there could be a tussle between this particular provision. Let's say if I am rendering some technology, if it falls within the ambit of royalty or fees for technical services, the rate under 115A is only 20%. Whereas under the treaty, in case of, let's say, some of the treaties where you have make available conditions, like US, Canada, UK, Portugal, Netherlands, in those cases you may very well come out of the tax duty. But under the Act, if you look at, they say 25% of the gross receipts. Under resident company, they have also told that it should be establishing or operating an electronics manufacturing or connected facility for manufacturing or production of electronic goods approved under the scheme notified by MeitY. So only the specified company, which is this resident company, notified by MeitY, if they receive the specified services from a non-resident, then only the non-resident is entitled for this. If the scheme is not being notified by the MeitY, but still the services are rendered in connection with the electronic manufacturing of goods, then the non-residents may not be entitled for this percentage taxation. To summarize, if you look at, we have, these are all the extreme right. You have different sections. Now all this being culminated in section 61. In subsection 2, where they have given you this table, how do I do the computation? And also if you look at serial number 4 and 5, we have already seen that it prohibits, it permits the non-resident to show income which is lower than the presumptive income. One interesting thing, if you could notice, is the highlighted portion in the red, where if you look at the existing provisions, says any prohibition of business laws or unabsorbed depreciation. Whereas the Income Tax Act 2025, it says prohibition of any loss. So it is not confined only to a business loss or unabsorbed depreciation, set off of any losses. So that is a slight change in the Income Tax Act 2025. Occasional shipping income is what we briefly touched upon, the existing section 172, which is now replaced as section 316. The shipping income dealt under section 61 is a situation where foreign company regularly carrying on its shipping income in India, whereas here these are occasional. So therefore the periodicity plays an important role when it comes to determining whether it is a regular income or an occasional income. Occasional income means, say for example, if any of the ships that are coming into India in transit, as part of in transit they are carrying some goods. Now that becomes occasional. But if there to be a foreign ship that are regularly coming into India, say they have a long-standing contract with some of the customers in India, whenever they want to export the freight, if they come and move the freight, then in respect of those cases, section 316 will not apply. You have to go and look at section 61. This has overriding effect over all other the provisions of the Act, including section 4. Because this particular section itself a specific charge, like how you have section 4 which creates a charge on income. This overrides section 4 itself and say I can provide a charge on this particular occasional shipping income for a limited period. That particular purpose is for levy and recovery of tax in case of the ships chartered by a non-resident. So at the time of, if you look at both this provision, regular also 7.5, here also it is 7.5, but there is no change with regard to the proportion of income. But the manner of levy and collection and then the filing of return, there is a change. So therefore, if a master of a ship, when he has to move out of India, then either he should file a return of income in India or he should designate someone that you permit me to move the ship out of India, the commissioner has to give a court clearance. Once the clearance has been given, he can move the ship, but with the condition he has to make necessary arrangements in India that someone should file a return of income in his behalf. Or alternatively, what he can do is he can discharge those taxes in the form of a proof of saying withholding taxes have already been discharged, or I have to pay advance taxes. So mostly if you look at it, resonates section 172. This is an optional provisions. In case if the non-resident feels that my income will be lower, then he can very well make a declaration to the assessing officer that I don't want to get covered under section 172. Rather, I will compute my profits on a normal basis. That option is available to this non-resident. Other two critical aspects which are forming part of our PGBP chapter is section 59, S12 section 44 DA, where a royalty or FT is earned by a non-resident. The royalty or FTS may be paid by a government or an Indian currency pursuant to the royalty agreement in respect of a right or property. But that right or property, the income which I generate, should be effectively connected with my permanent establishment. So even if you look at some of the treaty article with regard to article 12, which deals with royalty or FTS, the first para of article 12 talks about the right of the resident state to tax this particular scheme. And then subpara 2 talks about, however, I will grant the rights even to a source state, but if the recipient is a beneficial owner, then the rate of taxation has been curtailed, which are bilaterally negotiated. And then subpara 3 talks about definition of a royalty or FTS. Subpara 4 or subpara 5 generally, if you look at, talks about a situation where if a royalty income is being effectively connected with a permanent establishment, then in that case the priority is being given to article 7, where it is taxed as part of a business profits. Likewise here, if you receive a royalty or FTS generally, we go back to section 9, look at whether it falls under the royalty category or FTS category. Then you go to 115A to identify the rate of taxation under the domestic law, and if I have a treaty and if I am entitled for a treaty, I go and apply the treaty rates if that is beneficial. But when it comes to business profits, predominantly the right of taxation and the manner of computation is already been granted to the source country where this P is situated. So therefore in that cases it is taxable as a business profit. So therefore here it is taxable on net basis. If you have only royalty thing, there are certain restrictions on claiming and expenditure. That whatever expenditure that are not only exclusively incurred for earning this royalty. It is similar to our 37. Current 37, if I have not incurred any expenditure which are only or exclusively in connection with my business or profession, then 37 bars me from claiming this. Likewise, you have a bar on claim of reduction of expenditure. I am obligated to maintain my books of accounts under section 62 and audit under 63, which is 44A and 44AB of the current regime. If you look at existing regime, there is a specific subclause which deals with for the purpose of royalty or FTS, go and refer section 9. Whereas here that particular definition connection link is being missed. But because of which there is no issue is what my view is. Now you have another section which deals with head office expenditure. This is similar to our permanent establishment where there are occasions where head office incurs an expenditure on behalf of a permanent establishment. Say for example, you have a HOI branch. Majority of the expenditure that are required for the purpose of carrying out a business or profession of the branch is being incurred by the branch. But there are certain common expenditures that may be incurred by the head office outside India. So in those cases, there are some restrictions that are being placed. If you look at the existing Article 7 of many of the treaties which deals with the business profits, there also it says that computation of profits of an enterprise be given to the domestic law. So therefore, whatever is the computation mechanism as laid out by the domestic law has to be respected. So therefore, classic example, if you look at India-US treaty, there are certain expenditures that has been specifically said, but these are the expenditures that have to be allowed. And there is also an issue under the non-discrimination clauses of certain tax treaties, where there are certain tax treaties that are providing Article 24 Sapara 3, which deals with permanent establishment, where it says that I have to make a comparison between how do I compute the profits of Indian entities vis-a-vis how do I compute the profits of a foreign company. So if there are any discrimination in this, then to the extent that discrimination has to be ironed out. This is what some of the treaties, not all the treaties, some of the treaties, say for example US, UK, Canada, and then Japan, some of the treaties provides for it. So therefore in those cases, one may argue that I may not be subject to the limit that are provided under this section 16, that is the current 44 CUs. Because here if you look at, there is a limitation on deductions. In case of loss, I have to compute what is my average adjusted total income for the earlier years, 5% is allowed. In case of a profits, I will compute adjusted total income for the current year. Only 5% of that is the cap that is being allowed. What happens in a scenario where I incur more? So then to the extent it is a loss. In home country, they will not allow this expenditure because they will say this has been incurred for the purpose of branch, and if that branch profits were not get integrated in the home office accounts, then in those cases they may not permit it. In India, you may not permit the expenditure that are beyond this 5% limit. So in those cases, if the non-discrimination provisions, if it permits, one can take advantage of that particular provisions to say that I cannot be bound by these restrictions. This is a section which currently under the Act in section 90 and 90A. Section 90 deals with the situation where if Indian government has entered into a treaty with another country, they do have a treaty. 90A talks about a situation where specific territories, say for example Hong Kong is a specific territory with which India has entered into an agreement. So therefore 159 integrates both section 90 and 90A. And the purpose of they entering into this treaty has been similar to what we have under the domestic law. There are 4 limbs that have been provided for: granting of relief, avoidance of double taxation, and this is the amendment which they have made in 2020 without creating opportunity for non-taxation or reduced taxation through evasion or avoidance, etc. This particular limb was introduced subsequent to a 2019 notification for multilateral instruments. Then in 2020, they have amended section 90 to include whatever is there in the preamble of the MLA Article 6. They have brought it in 90. So there is a controversy now being going on in the application of MLA after the Nestle judgment. In Nestle SA, the Supreme Court has said that if you were to give a benefit under MFN, the controversy was India-Netherlands treaty, the rate of dividend is 10%, whereas India subsequently entered into a treaty with 3 other countries where the rate of dividend is 5%. But those countries have become an OECD member at a later point in time, not at the time of signing the agreement. So therefore, whether that particular benefit should be conferred to Netherlands, Switzerland or France entities, their respective counterparts, tax authorities have issued internal circulars from their end that 5% is entitled for by the French entity, Swiss entity or Netherlands entity. Supreme Court said, whenever there is an amendment in the tax treaty, especially in a case where the wordings of the protocol that cannot be borrowed directly from a third treaty. Say in this case, in India, Netherlands, it says if India has entered into a treaty with another country which is a OECD member, then the rate that was conferred to the third treaty should automatically apply. The word automatically is not used there. So this particular borrowing of third country into India and Netherlands, Supreme Court said is not automatic. There is a separate need for a notification. Somewhere in September 2022, in the context of India's scheme, India did notify with regard to the lower rate of taxes for FTAs. They are notified from 15%, they said henceforth you are entitled for 10%. But they never notified anything with regard to a make available asset. So this Supreme Court said it requires a further notification. Now, borrowing that particular aspect, what in couple of judgments, one by the Mumbai Tribunal and another by the Delhi Tribunal, has held that you have made a single notification, a cabinet approval in 2019, where India has signed into an MLA. Now MLA will be coming into effect based on the relevant entry into effect and other provisions of MLA provisions. You have not separately notified with regard to each country what are the changes that are captured as part of the MLA. So therefore, to the extent applying the principles of Nestle, I cannot permit adoption of MLA into the tax treaty. Although the argument of the department was MLA has to be read at parallel. It only modifies the treaty, but the tribunals stayed away from the argument that MLA has to be separately notified for each of the countries. So if you look at in 2019, we have issued one consolidated position with regard to each article of MLA, relevant paras of those countries that are subject to change. Now, as per the tribunal rulings, what they are saying is, for each of this country, I have to identify which are the paras that are subject to change because of the matching notifications given by the respective counterparts. This has not been done, so therefore they have said MLA cannot supersede. This controversy will continue to apply. There is one more interesting argument that was placed in the Delhi Tribunal was the notification was made in 2019. At that point in time, this particular link was not there. So therefore, the power to enter into a MLA, does it come from section 90 or not, is the point of question was also being raised. Because if you look at, it says it is an agreement with the country or a specified territory. Now multilateral agreement, one single umbrella agreement can come included as part of a bilateral which was envisaged in section 159. Is also a point of controversy. Then for exchange of information and recovery of income tax. These are some of the important purpose for which a tax treaty is being entered. Now you have section 92 of the 1961 Act, which says that between the Act or the provisions of the DTA, the provisions of the Act to the extent beneficial can apply. So in other words, if the provisions of treaty is beneficial, then you apply the provisions of treaty which got provided in section 159(4). So therefore, there is no change at all. 159(5) is a situation where a non-discrimination provision. Earlier it was in the context, it was in the form of an explanation. Now they explicitly provided as part of a subsection, where there is always a rate differential between a domestic company and a foreign company. Now if you look at the domestic company, you have 4 different rates. 15% is there, excluding the surcharge. If one were to include the surcharge, it will be 8 or 9 rates. Excluding the surcharge and cess, if you look at, we have 15, 22, 25, 30. Now if you look at the foreign companies, it is now 35. Earlier it was 40. So therefore, merely because I tax the non-resident company at a higher rate, that cannot tantamount to a discrimination is the main aspect of this particular subsection. But if you look at certain tax treaties under the non-discrimination clause or some other provisions in protocols, there were explicit provision which says that the differential cannot exceed so much rate. US is one particular country where I could think of where they have said the difference cannot be more than 14%. My recollection was there are a couple of ARs that have been filed on this aspect, where when the rate got reduced from 30 to 25%. At the time the rate of non-resident company is still 40%. So therefore it exceeds the threshold in certain cases. So therefore in those cases there were some matters that were pending on this particular ambit. Subsection 3, the existing Act, is introduced in a modified form here, and it's somewhat against the same policy response that were given by the Ministry of Finance in the JPC recommendation report. If you look at here, it's a one situation where some of the provisions are beyond the policy level will change. This controversy came in interpretation of the word may versus shall in Pudanagan Chettiar's case, where the court, Supreme Court has held may has to be read as shall. To overcome that particular ruling, 90 subsection 3 was introduced, where they say if some term has not been defined under the treaty, then the central government may by notification provide for the definition for that particular term. So therefore they have initially notified under 90 subsection 3. What do you mean by may, or what do you mean by shall? Is what we clarified. Now this particular provision has been introduced in a different form to say that any terms, if it is already been defined under treaty, then go by the treaty definition. This anyway comes as part of Article 3 under the respective DTAs. If a particular term is not defined under the treaty but defined under the Act, then it will have the same meaning. But if you look at Article 3.2 of all the tax treaties that India has entered along with the model convention, it says that I don't have to look at the definitions of domestic law unless the context otherwise requires. Otherwise they say go and do an autonomous interpretation. What is the common understanding of that particular term rather than getting into the specific definition under the domestic law. And there was also a controversy if it is a domestic law, which country is domestic law? Why should someone go to only source country domestic law? Why not a resident country domestic law? This controversy is also currently there. And if you look at majority of the ruling, even in the case of engineering analysis, they say whatever amendments that you have made under the domestic law, whether can it be read into the treaty or not. So those sort of controversies will continue to persist even here as well. Then say if the domestic law also does not have a term, then central government may notify this. If the notification is not there, then say go and refer the terms from any other tax law. But any other tax law means should I look at only either if it's not there in income tax act, then obviously I should only refer the goods and service tax. Now the other issue that could come is if there are no taxes, then you go, it says go and look at other law that are being notified by central government. So this is, if you look at the last two lists, to that extent it is a overarching with regard to the existing provisions. Currently if you look at section 90 subsection 3, it never says, it stops at notification. If there is no notification, go with the autonomous interpretation, or unless the context otherwise requires, go and look at the domestic law. But somewhat it extends the principles of how we use the definition of copyright, borrowing from the Copyright Act. Somewhat it gives you a codified procedures to look at those particular provisions. Now current section 90 subsection 4 talks about requirement of a tax residency certificate, and 90 subsection 5 also talks about other informations if some of the particulars which was envisaged in the rule is not being present in tax residency certificate. For example, tax identification number is not there, email or the contact numbers of the concern is not there, then it says you have to go and file a form 10. Those sort of procedures continuing here as part of 159 subsection 8 and 9. So therefore there is no change, and you still have a controversy with regard to not filing of form 10, whether can it deny me a pre-dependence, because you have a TRC already in hand. If TRC has all particulars, then there is no requirement to file a 10. There is an issue that is coming in with CPC, where you have a tax residency certificate, but if you have not filed a form 10, in 143(1), when they process the return of the foreign companies, they are denying the PDAs. This issue is also going on. Or they apply the domestic law rates, denying you the PD benefits. Quickly touching upon the capital gains provision itself. If you look at 2024, there is a significant change that has happened with regard to the reclassification of long-term capital assets and short-term capital assets and rationalization of rates. Same thing continues here. If it's a long-term capital assets, it's 12.5%. Unlisted debentures, it is deemed to be a short-term capital asset, and they say you pay at rates in force. In case of short-term assets, if it's listed, it says 20%, unlisted again rates in force. One controversy which could emerge in the context of this unlisted debentures, which says that deemed to be a short-term gains. You have this special bench ruling of the Mumbai Tribunal in the context of transfer of depreciable assets, where the assets were owned for more than 36 months. For the purpose of section 50, it is deemed to be regarded as a short-term capital gains. So the Mumbai Tribunal, that is the special bench, has said, although it is for the purpose of it is a short-term capital gain, but for the purpose of application of rates, I go only by the nature of asset that has been transferred. Still, the assets has been held for more than 36 months, so I will still apply the long-term rates. So the same controversy could even come in debentures. Yes. You had a question?
I didn't understand that.
So what happens is, in case of a debentures, even if you hold the debentures for, let's say, more than 24 months, they say, let's say for example, more than 24 months if you hold, 5 years if you are holding a debentures. Generally, if you look at under the SQL regime, it is regarded as a long-term asset. So whatever the rate that are applied to your long-term asset should apply. Now what they are saying is, I will disregard the period of holding for unlisted debentures. It is deemed to always be in a short-term rate. So therefore, you look at the arbitrage now you have. From 12.5%, you will end up at maximum marginal rate, which can go up to 39% if you fall under a new regime. If you are under an old regime, you will end up around 42.72%. So there is a rate differences. Now in the context of depreciation, you have section 50, existing in section 50, which says that any depreciable assets, if the block ceases to exist, then it is regarded as a short-term capital gain. This was challenged before the special bench, it says, because there was divergent rulings. One bench said it is a short-term capital gains, so therefore apply the rate applicable to short-term asset. One set of tribunals said no, gain may be a short-term capital gain that is limited for the purpose of section 50, computation alone. But for rate, I will still go and apply what is the period of holding. So if the period of holding more than 36 months, they said nothing doing, apply the long-term rate. So the same controversy can emerge even here as well, because it is creating a fiction to be a short-term capital.
So, but there is no difference in computation mechanism for both short-term and long-term.
Rate differential is there, right? Now the arbitrage is significant. 12.5 versus 30.
For unlisted debentures, there is no difference between the long-term and short-term rates.
Currently, but this could pose a challenge based on the recent special bench. If one were to challenge that, currently you are treating it as a 30%, but if I were to apply the proposition of the special bench ruling, wherever I have held the debentures for more than 24 months, I can still argue that I will be entitled for 12.5%, not 30%. And then the controversy of the existing section 48 versus 112, where section 48 says in case of shares of an Indian company, if it is acquired in foreign currency, then computation has to be done in foreign currency, that the gain is only being converted under Rule 115A. Now, the rates are provided in section 112. In this case, it is 198. So there what it says is, if your total income consists of any capital gains with regard to shares of an Indian company, then don't give the benefit of first provision. So therefore, to this extent, your computation is getting modified in section 198, currently section 112, with regard to non-resident. So the effect of this is, say for example, when you have invested $1 lakh at the rate of 50. Now what you have got, same $1 lakh, but at the rate of 80. Computation wise, if I do in foreign currency, there is no gain, 0. But if I don't give the effect of this first proviso, which means I can't compute the gain in foreign currency, then there is a gain of 30 rupees per each share. So therefore, for 30 lakhs, I may end up paying tax under 112. This issue also came in a recent tribunal decision where the result of the computation in foreign currency is a loss. So therefore the taxpayers argued that there is no scope for me to recompute it to 112 because the language of 112, which is maintained even in 198 as well, if the total income consists of any gains as defined in first proviso to 48. Under first proviso there is no gain. So obviously my total income does not consist of any gains as per 48. So therefore there is no scope for recomputing this particular item under 112. But the Mumbai Tribunal said nothing doing. 112 is a specific provision. So they have looked at 48 versus 102 as a two different provisions and said you have to recompute it in 112. So therefore in that case the taxpayers end up paying taxes on foreign fluctuations. Only exchange rate they end up paying taxes. So those set of issues even continue here as well. Section 207 equates with our 115A, which provides for rate of taxation for specific streams of income. If you look at dividend, other than dividend from unit in IFSC, the rate is 20%. In case of unit in IFSC, it is 10%. Interest other than serial number 4 or 5, because this talks about our old 194 LC and LD, where now this particular provision is no longer in force, except for the matter in case of 194 LD. If you have borrowed a rupee denominated bonds before 1st July 2023 and the interest is still continuing, this particular provision will continue. But if the loans were repaid, then this provision will not have any particular impact. Likewise, interest from borrowings in foreign currency, rupee denominated bonds, or rupee denominated bonds or long-term bonds listed in IFSC stock exchange, then the rate will change depending on IFSC. Because if it is in case of RDB or LTB listed in IFSC, it is 4%. And the period it relates to is April 2020. And in case of 1st July 2023 onwards, the rate is 9%. If any RDB or long-term bonds are issued after 1st July 2023, now the rate is 9%. Distributed income by business trust, 5%. There are some conditions attached to this aspect. We will deal with business trust separately. Income received in respect of unit purchased in foreign currency by mutual funds or UTA, it is 20%. Other incomes, obviously, let's say for example, interest in the form of CCDs. Because CCD was never issued in foreign currency, it is in Indian currency. So therefore, in those cases, it will be rates in force, which could be maximum margin rate, it will apply. Royalty or FTS, it is 20%. You have an existing provision which says that if the tax is being withheld as per the rates under this particular section, you are not obligated to file the return of income. That is still continuing. And all this income is taxed on a gross basis. There are no deductions. You will not even have a basic exemption limit for these incomes. This one section, with this we will break for a brief moment and then we will again resume, because this is an independent section other than the non-resident. This is the erstwhile 115 DBA. which deals with taxable income of non-residents or foreign persons, foreign citizens, who are entertainers or athletes for participation in game in India, not online games, other than online. So why I put this map is just to say recent World Cup has happened in India, so that we can connect with the Women World Cup, where a lot of foreign players have come and participated in India. Whatever the income that they have generated will get ideally taxed in this particular section. Or if the sports person is contributing any articles to any sports magazines, advertisements, or articles in newspapers or journals, then this particular provision will trigger. There are occasions where they may not receive this income directly, but they may receive this income through a company. So they may set up a company. If you, for example, if I have to go and make Dhoni to appear in an advertisement, there is a specific entity through which only I can enter into a contract. So it's more of a agency company that they have. I have to enter into a contract with them. Likewise, if I have to enter into any contract with any of the sports person or entertainer for any of this, say one-off event, if I have to perform. There is a classic case where there is a MRF Pace Foundation in Chennai, where Mr. Dennis Levy used to come and appear. Even Negra used to come and give a coaching to all the young generation. So the contracts are entered with those association to which Negra Levy is being associated. So the payments are directly made to them through the agency, or indirectly to them through the agency. So in those cases, it includes guaranteed payments as well. Of course, other than the online billings. So this is applied to a non-resident and foreign citizens. 20% is the rate of taxation. No deduction has been allowed. It is taxable on a gross basis. If 20% has been deducted, there is no obligation to file any profit return. This is the case where we had the Supreme Court decision in the case of a PILCOM, where in respect of 1996 World Cup, where India, Pakistan and Sri Lanka were the co-hosts, and Pakistan hold the final, where India has to make some payments to ICC as part of some guarantee payments. Now what was the argument with regard to this is, if you look at, it simply says following income is taxable. Whereas under 195, the existing 195, it uses the word any person responsible for making any payment to a non-resident which is chargeable to tax in India. So therefore the argument of PILCOM before them was, under 195, tax has to be deducted as per rates in force. Now rates in force definition, if I go, it also provides for me to apply tax treaty rates. So therefore under the tax treaty, this particular guarantee payment which I have made to ICC is not taxable at all. So therefore there is no obligation for me to withhold any taxes. But Supreme Court said this, if you look at 195 versus 115 BBA, 115 BBA is more specific provision. Here, there is no sum chargeable to tax has been used. So therefore, it is mandatory for you to follow this section to deduct tax as per this section. Later on, the recipient may look at the tax treaty, file a return of income, take a refund. So this is the argument, or this is the ruling of the Supreme Court in PILCOM. So the same set of issue could even continue in section 211 as well. It never uses the word sum chargeable to tax. So therefore, if you feel section 393, current 195 versus 211, one has to go with section 211, and if at all subject to any relaxation under the treaty, if the non-residents be able to argue that it is per se not taxable, then they can file the non-income and tax it. Majority of The treaties, if you look at Article 17, deals with artistic and sports person related taxation, where always the right of taxation has been given back to the source country. So therefore we have to be very mindful of with regard to the deduction under 115 BPA versus section 317 versus 390. With this I will stop for a brief moment. We will continue. If you look at this is just the comparative table between the current provisions and what is the corresponding sections in the erstwhile sections. So if you look at interpretation, non-resident definition, there is no change. Someone who is a citizen of India or a person of Indian origin. The definition of foreign exchange asset remains the same. Only thing, if you look at the current provisions, you have to go round about as to what do you mean by foreign exchange asset. It says a specified asset which are bought in foreign currencies. Then you go and look at what is the specified asset. There is a 5 class of assets that are there. Shares in an Indian company, debentures issued by a company which is not a private company as per the Companies Act, Section 2 Clause 68 of Companies Act 2013, which says private company is one there. It restricts the number up to 200 and there is some restriction on transfer of shares. This is the definition as per the Companies Act. So same as we borrowed here. Deposits with an Indian company which is not a private company. Security of the central government as defined in 2 subclause F of Government Securities Act 2006 or such other class of assets that may be notified by the central government. So what do I get exemptions for? One, if I transfer any of these specified assets that are acquired in a foreign currency, I do a rollover, I reinvest it in a specified asset. Like how we have section 54 series, where you have a residential property investing in a residential property. Likewise, the same kind of rollover benefit has been given here, but only with regard to 2 streams of income. One, it is long-term capital gains, and second is the investment income. So these are the 2 aspects. Short-term capital gains, there is a controversy whether it may fall under the ambit of investment income, but if you look at it, says any income derived from a foreign exchange assets. So therefore the income has to emanate from the asset and the asset should be in subsistence. Whereas in case of a short-term capital gains, the asset goes out of here. So it does not in existence. So therefore only those situations where existing asset is there and you draw some income out of it. Say for example, you have a deposits. You draw interest. Deposit is also debentures. You get interest. So that particular interest gets covered as part of interest income. Whereas when you sell the asset as it is, and if it is a long-term asset, you have 12 months for shares. In case of non-shares, it is 24 months. So therefore, long-term capital assets, you will have a rollover. So this is fundamental, what they call it as an interpretations, similar to the definitions under the erstwhile law. Now computations, if you look at taxable on gross basis, no deductions allowed. If you have any other income apart from these 2 income, then out of that income, your chapter 8 deductions, similar to your chapter 6 now, will be permitted. Rate is income from investment, it is 20%. So essentially if you look at what is this income from investments, basically interest from debentures, interest from deposits or interest from securities of the central government. And if you look at the rate, it says 20%. Now if I were to compare this with 115A rates, there also majority of this income falls under 20% except for interest income which may go up to rates in force. Here there is 20%. So that is a one particular benefit. And in case of other incomes, you have rates in force. Now this is a specific section which gives you a benefit of rollover benefits, where if you have long-term capital gains from any specified assets, then similar to your 54 or 54 EC 54F, within 6 months from the transfer or conversion of that asset into money, you reinvest it in another specified assets. Then whatever gain that are derived from that particular transfer is not taxable, you will get an exemption. In case only portion of net consideration has been invested, then the exemption will be restricted to that particular proportion. And there is a clawback provision as well, like how you have in 54F or 54. When you transfer the invested assets within a certain period of time, then whatever the capital gain exemption that was already granted to you will be withdrawn. But that particular capital gain is taxable only in the year of transfer of the new asset. 3 years is the timeline that they are given. So this 3 years, if you look at, originally was there as part of other assets, where the long-term assets period is 36 months. So therefore they used 3 years. But unfortunately, when they rationalize some of these provision into 12 months or 24 months, this never been touched upon. Still it is 3 years. So therefore one has to be mindful of, if I have to take a rollover benefit, I cannot transfer the new assets for a period of 3 years. So this is a choice provision, not a mandatory. If I want to get covered as part of this, then at the time of filing a return of income, I have to specifically put a tick mark in my return that I want to get covered under this. Otherwise, you can say I don't want to get covered under this. I will pay my taxes as per the normal rates. Where the only arbitrage which will come only in the context of interest income, where the rate is higher in 115A compared to what here is 20%. Now moving on to some special regimes with regard to certain categories of non-residents. I am using foreign portfolio investor as a common name because in 2014 FIA and FPA got merged under the SEBI regulation, so therefore I am using the terminology foreign portfolio. But if you look at the section, it still uses FIA. So section 210, our erstwhile section 115 which talks about income of a foreign institutional investor, which is foreign portfolio investor, or a specific fund, shall be taxable as follows. Specific fund, again one has to go back to schedule 5. There is a specific definitions in the note which talks about the AF category and IFSC related provisions as well. So there, if you look at, if it is an FIA, 20%, then if it's a specific fund, which is AF category 3 or retail scheme or exchange traded fund, as per the IFSC regulations, it is 10%. Short-term capital gains on any securities other than section 196. Section 196 is nothing but our existing section 111A. Where it is a listed securities, the rate is 20%. So it is assessed other than listed securities, so therefore the rate is 30%. Even if you look at this particular provision under the existing act, it is simplified in the form of a table. So I have confined the table into this fashion. Long-term capital gains, again being dissected into listed and unlisted. If it is, now there is no specific differences in the rate except for your grandfathering portion with regard to those equity shares that are grandfathered up to 31st Jan 2020. And in case of listed, you have this exemption limit of 1,25,000. So that is the only differences between listed and unlisted. Other incomes, rates in force. Now few aspects of FIA is FIA definition as notified by the central government. Specified fund, if you look at, this applies only to the extent income is attributable to units held by non-resident not being a PE of the non-resident. If a non-resident's PE in India holding this particular investments, then to this section this particular provision will not apply. Specified fund, I have just carved out the definition from Schedule 5 here. Funds established or incorporated in India, which could be a trust, company, LLP, or a body corporate located in IFSC, which further calculated into AF category 3. AF category 1 and category 2 comes under a separate regime. So category 3 is covered as part of this. Regulated under IFSC and the fund managers regulation, which is the retail scheme or exchange traded funds, subject to such other conditions that IFSC regulations may provide for. Investment divisions of offshore banking unit, CAT 1 FPA, under SEBI, which fulfills the condition, is also regarded as a specified fund. Then again, if you look at the gross total income, in case of income from securities, no deductions are allowed. Chapter 6A, which is chapter 8 here, allowed to the extent you have other incomes. And provisions of 72(6) shall not apply to serial number 225 in computing the capitals. That is this first proviso to 48, which is now recasted into section 72 subsection 6. One critical aspect is the indirect transfer implications, because what happened is in 2014 you had 3 categories of FPAs, FPA 1, 2 and 3. Now FPA 1 and 2 has been merged into FPA 1 in 2019 regulation. Category 3 of 2014 regulation is now regarded as a category 2 FPA in 2019. So if you look at section 9 indirect transfer provisions, only category 1 FPA is being given a relaxation, which is category 1 and 2 of 2014 regulations. So therefore, if there are any category 2 FPAs, which is 2014 regulation category 3, you will still be subject to indirect transfer provisions. There are no grandfathering for that particular category. Units acquired in foreign currency. Specified income, which is the income that is being tabulated below, which is acquired by the overseas financial organization, basically offshore funds. If the income is purchased in units is purchased in foreign currency, then 10%. Long-term capital gains is 12.5%. Basically, your interest income and dividend is being charged at a lower rates. In case of other incomes other than this, if we have other incomes, then rates in force. Same, no deduction has been allowed in case of 1 and 2. Chapter 8 deductions will be allowed only with regard to other income. What do you mean by offshore fund? If you look at any fund, institution, association or body established in the laws of foreign country, entered into an arrangement for investment with SEBI, investment with a public sector bank or mutual funds including UTA, public sector bank, public sector institution, mutual fund specified in Schedule 7. If you look at serial number 20 or 21 in that particular schedule, the mutual fund is being defined there. Earlier one may have to look at section 10, because all these provisions will throw you to section 10 to see section 23, the 10 subclause 23, where mutual funds are defined. Now everything has been moved to, definitions are moved into notes. So therefore there, if you look at specified mutual fund is nothing but mutual funds registered with SEBI or Unit Trust of India. And this arrangement has to be approved by SEBI. then only you are entitled for this particular rate for offshore funds. Global depository receipts. Now again they are bifurcating this with regard to different segments. Interest on bonds of Indian company as per scheme notified by central government, or bonds of public sector company sold by the government, but in these two acquisition has to be in foreign currency. If the acquisitions are in Indian currency, then you are not entitled for this particular lower rate. Then with regard to dividend of GDR, they have three sub-conditions. One, it could be with regard to GDRs issued by central government against the initial issue of shares of ICO, or issue of shares of a public co sold by the government, existing shares. Or third is issued or reissued as per central government scheme against existing ICO shares. But this purchase should be in foreign currency, either you can directly purchase or through an approved intermediary. Approved intermediary, again it has to be as per the scheme notified by the central government. Long-term capital gains on transfer of bonds or GDR, it is only 12.5%. Other income, it is rates in force. If you look at again, you have this first proviso 248 in the form of 7266A, where computation, first you have to give up the benefit of computing the income in foreign currency. Withholding of taxes, section 393 subsection 2 in case of non-resident. Subsection 1 table has to be looked at in case of a resident. GDR has been specifically defined as per section 193 subsection 4 clause A. It says any instrument issued by overseas depository bank. Giving the definitions of GDR, any instrument issued by overseas depository bank outside India or IFSC to an investor. Basically, it is an underlying instruments of an Indian company shares, but I am issuing a GDR outside of India. It may be in a Nasdaq stock exchange, or it could also be in a case where IFSC stock exchanges as well. Or it could be a foreign currency convertible bonds as well, not necessarily a share, it could also be a FCCB. Or foreign company shares against which if they are issuing a GDR, but the foreign company should be listed in IFSC. So these are the three aspects that are defined in section 193 subsection 4 clause 3. Tax on income from securitization trust. This is a case where a trust is being formed either as a special purpose vehicle where they acquire some liquid assets from various banks. It could be a trade receivables or it could be some loans that they have given. They acquire it, they pool it, and then they issue securities against this to the investors and collect money. So basically what a securitization trust does is they acquire some of the standard assets of the banks or other financial institution and monetize it for the investors. So bank also free from its collection. That if let's say for example I am in dire need of liquidation of my loans. Instead of me go chasing the borrower, I can immediately liquidize it by selling this asset to a securitization trust. Against this, they will issue instruments to the investors. So whatever income that are derived from that derives a pass-through status. So a securitization trust may not be subject to taxation. There is a specific exemption that has been provided in Schedule 3, serial number 26, where income of a securitization trust is exempted. But whatever income that they generate, that is taxable in the hands of the investors of the securitization trust. But the characterization remains the same. Say for example, if securitization trust earns an interest, then in the hands of investor it is regarded as an interest. Security trust will not pay any taxes on this particular income. Likewise, if they earn any capital gains, same characterization holds good for investors. Now it also talks about a situation where there could be a situation where the trust may declare its income or it may not. In case it would declare, you already have the income, but if it not declared, then on the last day of tax year, whatever is the income that has been approved, in proportion of the investments by the investors gets allocated. A securitization trust will also file a specific form to the investors with regard to what is the amount that are distributable to each of this investor. In the same proportion, the investor will be taxed. Once a particular year, say for example, March 25, there are income distributable in the hands of securitization trust. This has been already taxed in the hands of investors. But in the subsequent year, actual distribution happens. Then again, we will not be subject to taxation based on actual distribution. So to the extent, this amount will be reduced from the distribution. Who is an investor? Holder of a security debt instrument or securities or security deposits. In either of the three forms, ST can issue to the investors. Each definite what is a security, what is a security receipt has been separately been defined, and they have borrowed the definitions as it is in the 1961 Act, except for the fact that we may have to trace these aspects through the schedules in certain cases. Likewise, if you look at the classification exemption for the securitization trust, either two we will be looking at section 10. Now you have looked at a maze of three schedules, 3, 4, 5, or rather 4. Four schedules, 3, 4, 5, and 6. This is a case where you have venture capital undertaking, which has overriding provisions. The exemption or the tax treatment is for the investors who invest in venture capital undertaking, which is venture capital fund and venture capital companies. So the taxability on investors of VCC and VCF. VCC and VCF get the money from investors and they will invest in VCUs. So they will get the revenue generated from VCU, then VCC or VCF will declare it further to the investors. So similar to securitization trust, you will have a pass-through mechanism here as well. Whatever is the income that are earned by the venture capital company or venture capital fund, sacrosanct, the characterization applies to the investors of VCC or VCB. How VCC or VCF is being exempted, you look at Schedule 5, serial number 6, that is where you will get the exemption for VCC and VCF. Same mechanism. If the distribution has not happened, then depending on the proportion of investment, allocation should happen to the investors. A specific declaration will be filed by the VCC or VCF. And whatever the payment that are made from VCC to VCF will not be subject to TDS. And the carve-out is section 222 will not apply in case if the investor is an investment fund. Investment fund, if I were to look at 224.10 subclause 8, it talks about AAF1 and AAF2 category. So there is a separate regime. So therefore, they carved out AAF1 and 2 from this VCC and VCF. Again, the definition of VCC, VCF and VCU, one may have to look at Schedule 5 Note 4, which takes you to SEBI related definitions. Income of a unit holder and business. This is some funda, and there are some connected provisions there along with the relevant schedules. If you look at the section wise, it's only 4 paras. Pretty simple. But one may have to connect this with several other provisions and the schedules. Overrides all provisions of the Act. Subject to 196, 197 and 198. Business trust is taxable at MMR. 196, 197 and 198 is nothing but section 111A, 112 and 112A, which is our capital gains. Because the rate of tax for capital gains in this 20 or 12.5%, so therefore subject to this particular provisions, business trust is taxable at MMR. Business trust has been defined in 221 to say InvIT or a REIT, real estate infrastructure. Again, the pass-through mechanism is there. The characterizations remains as it is. Pass-through status is available for interest, dividend, capital gains. With regard to the business income, business trust is taxable. That is why it is taxable at MMR. With regard to rental, you will have a pass-through mechanism. They generally file a statement similar to securitization trust or a DCC with regard to what is the proportion of income that is being distributed to the unit holders. Now, if I have to bifurcate this with different provisions, Schedule 5, serial number 345, talks about the exemptions for business trust. In what situations? It is subject to certain conditions as well. And there is one particular provision, section 92, subsection 2K, which is our existing section 56(2), clause M, where in case of distribution by business trust is in the form of repayment of loans, then 56 will apply, subject to a formula. The same formula has been retained in 92 subsection 2, subclause 3. Section 393 provides you the rate of withholding. Section 196, 197 and 198 talks about capital gains tax rules. This is just an overall bifurcation of this scheme. I have bifurcated into several streams of income. How does it work with regard to which stream of income, what are all the provisions that will have an impact. See, if you look at this, yes.
Sorry, one question. So the rental income for a REIT would also be would be part of the pass-through. So if I am a unit holder and I'm basically the REIT is passing through the rental income, would I be can I enjoy the standard deduction of 30%? Is that something that I as unit holder?
Then here it comes the question of classification, whether the rental income is a business or a income from house property. That classification will place a because what you do is only a unit, and the purpose of REIT is only to monetize it. Generally, it will be a business. There is a specific issue with regard to other expenditures that are expenditure, whether that particular how allocation happens, those issues are there. Not addressing it for the moment because that could itself be taken as a one separate discussion. The swap of shares. See, normally what happens is investment in the ultimate real estate assets can be held directly by the business trust or it can be through a SPV. Let's say for an example, as an investor, if I have shares of an SPV, now I want to swap the shares of an SPV with the units of the REIT. Then in that case, there is a specific provision that has been provided in section 70 clause Z, which is our existing section 47, transactions not regarded as a transfer. So this swap is being exempted and the cost of acquisition will continue. What is the cost for the SPV will be the cost for the unit of the REIT go forward basis. Period of holding, there is a continuity, but exemption, if you look at from a 56 standpoint, there is no specific exemption that is being carved out, but one can always argue that what I am entitled for is I have given up something and then got something, so therefore it is not without a consideration or an inadequate consideration. So to the extent there is a swap of shares, there is an exemption. Now if there is a sale of units of REIT by the investors, then depending on period of holding, your taxation will work. If the REITs are listed, then short-term gains you will have 20%. But if it is sold off market, then you will end up at maximum margin rate. However, subject to tax treaties. Majority of the treaties, if you look at, it uses the word sale of shares or something. So therefore, units may not get covered under. So predominantly, some of the investors from say Singapore or other can make use of the treaty. So say that it falls under the residual cost, so as to get an exemption at Singapore. Distribution of dividend or interest. Again, if you look at, there is a pass-through. Schedule 5 serial number 3 provides a taxation. What is the taxation level at the unit holder level? Non-residents, as per DTA, can be evaluated. Under the domestic law, if you look at, the dividend is depending upon if it is through an SPV. Whether the SPV has opted for special rates of taxation, like how we have this 115 BWA, 22% rate. If the SPV has opted for 22% rate, then the dividend received from SPV to REIT and REIT to unit holder will be subject to taxation. If the SPV is paying tax at the higher rates, 30% rates, then dividend is exempt. Withholding is being provided in section 392. One have to look at both tables. Under subsection 1, you have a table for residents. Under subsection 2, you have a specific table for non-resident. And then under subsection 3, you have a table for basic exemptions, limit for withholding. So summary-wise, if you look at non-resident unit holders, if you look at serial number 5 and 6 in subsection 393 2, where in case of an interest income it is 5%, dividend income it is 10%. I have given the extracts of this table at the end of the slides. Other income streams, if you look at rental income also out of assets directly held by REIT, business trust is not subject to taxation. There is a pass-through that is available. Trust shall withhold taxes in case of domestic shareholders, 110%. In case of non-residents, rates in force. Any other income, if you look at, then taxable at the trust at MMR. Once the trust is being subject to taxation, any further distribution of that taxable income is subject to exemption in the hands of unit holders. Likewise, any distribution in the form of a loan, repayment of loan, based on the formula is subject to taxation as other incomes. Taxation of AF. So we do have 3 categories: angel funds, VCF, SME, social venture, infrastructure, and 1 category. Category 2, you have private equity funds, structured credit, debt funds, real estate funds, and category 3, you have long only fund, long short funds, hedge funds. So just to give a bifurcation as to what we cover. So as part of section 224, we are going to cover only the category 1 and 2. Because category 3, there is no specific provision. There are some controversies around with regard to category 3 as to the characterization of that particular fund. Now again, similar to a business trust. Business income is taxable in the hands of an AIF, whereas other income streams enjoy a pass-through status by virtue of Schedule 5 serial number 1 and 2, where there is an exemption that has been granted to AF category 1 and category 2. So therefore, you achieve the pass-through by looking at this particular provision. Either we will look at section 10(23) to look at what is the exact pass-through that is being achieved. Now we have to go to schedule 5. Securities held by Cat 1 and Cat 2 is regarded as a capital asset, similar to our section 2 clause 14. The issue here is on the what is the nature of loss that could be passed on to the unit holders. If you look at any capital loss that has been incurred by category 1 and any loss incurred by AF category 1 and category 2 can be passed on to the unit holders, provided the holding period of that security is 12 months. If the holding period is less than 12 months, there is a bar. So this is currently even an issue even under the existing regime. What will happen to that loss? Can the loss be utilized by AAF as such in the subsequent years when they have a gain? But possibly not possible, because any gain that has been made by AAF 1 and 2 has been passed through status. So therefore loss on short term has never been passed on, whereas gain has been passed on to the unit holder. So to this extent there is an anomaly between the set off of short term losses. Again, TDS is being provided in section 393, subsection 1 and subsection 2, depending on we are looking at domestic or foreign holders. Category 3, if you look at, there is an issue with regard to taxation. Whether this category 3, which is a trust, whether it could be regarded as a specific trust or a determinate trust versus indeterminate trust. Because under the existing regime 161, if you look at, if it is a specific trust, which is where beneficiaries are identifiable at the time of signing the agreement and their shares are known at the time of signing this agreement. Let's say in a trust, if there are 10 investors are there, each of this investor are put 1 lakh. So the entire pool of fund is 10 lakh. So I can now identify these are the 10 individuals and 10% is the each income. So therefore this becomes a specific. Now there are occasions where I keep adding on to the investors over a period of time, and the proportion might undergo a change each time when additional people get contributed 1 lakh and 1 lakh. Say for example, at the time now we have 10 lakh capital with 10 people. Now by the end of year 3 I may have 30 or more people contributing 30 lakhs. So essentially whatever is 10% that I was holding in the initial years essentially become 2.5% by year 4. So therefore this capital is being fluctuating and then their contribution is also fluctuating. So in that case there was an issue, what happens to this particular scenario, whether it could be regarded as a determinate fund or it is still an indeterminate fund, because rate is different for both. In case of a determinate fund, it is taxable like manner to the same extent. So therefore whatever is the rate that are attributable to the investors, that is the rate will apply. So if there are several investors having multiple rates, with regard to each investor I may have to see what is the status of that person, what is the rate applicable to that person. But if it were to be regarded as an indeterminate trust, then the entire income is taxable at MMR. And we already have one level of controversy with regard to MMR on whether that MMR applies to all streams of income or in case of capital gains, whether the special rates will apply or not. So there are divergent of rulings with regard to that particular issue, where Mumbai and Tribunal said special rates and the capital gains tax will apply, and Chennai Tribunal has ruled it against it says if it's MMR, you go and apply whatever is the highest start rate you have to apply. Now recently we have this special bench ruling in Aryadhya jail, where with regard to surcharge, they have said whatever is the relevant slab rates applicable for that particular surcharge, that alone can apply. The same principles could equally borrow even for capital gains purposes as well. And you have this Karnataka High Court ruling in the case of India Advantage Fund 7, where they have said if there is a contribution agreement, if the contribution agreement is fluctuating depending on number of investors getting added, and their proportion can be arrived at based on the formula provided in the agreement, you cannot call this as an indeterminate fund, it is still a determinate fund. Because I know who is the party, and depending on the level of contribution they made into the fund, the proportion has been identified. The same was followed in the recent Delhi High Court ruling in Equity Intelligence EAF Trust, where they have said it is a determinate trust. So therefore, it will be like manner to same extent. So this is the controversy surrounding Cat 3. Now coming on to taxation of AF, specifically located in IFSC. Pass-through status has been granted for all incomes other than business income. In category 3, there is no specific mechanism, so therefore there is no pass-through. Business income, if you look at with regard to specific incomes in IFSC, offshore banking unit or other qualified financial operations, you have a tax holiday that are available under section 80 of the current regime, which is continued here in chapter 8. So therefore that particular provision is applicable, which is section 147. So now we have to redefine our understanding on 147. No more a reopening under the new act. It is 80 LA in a rehashed form. Income from offshore investments. If you look at category 1 and category 2, either two it was exempted by circular 14 of 2019. Possibly one may still argue till a new circular has been issued, the same circular will apply. But here, for category 3, it is exempt subject to certain conditions. That is, acquisition should be in a foreign currency, and then the investor should be a non-resident, not being a PE of a non-resident. So those sort of conditions has been provided in Schedule 6, serial number 2 and 3. If you look at Schedule 6, it's purely dealing with IFS related provisions. Income from onshore investments. For Cat 1 and 2, you have lower of factor BTW. If you look at category 3, in case of a specified instruments, there is a specific exemption in section 71R, which is nothing but bonds or global depository receipts or RDB issued by rupee denominated bonds of an Indian company or derivatives or such other securities as may be notified. So these 4 categories of assets are exempted for Cat 3. Transfer of AF units by non-residents, again lower of factor in the double taxation. With regard to Cat 3, it is exempt. Reference again 70 subsection 1 now. Alternate minimum tax is applicable if the AF were to be set up in the form of a LLP or a company. With regard to category 3, there is a specific exemption in 206 subclause 2. 206 subsection 2, clause B, subclause 4, which is similar to our 115 JB related provisions. If you look at Cat 3, it is only with regard to units held by non-resident, except sponsor or manager. So the definition comes from clause G of note 1 in schedule 5. 147 deductions for specified business in IFSC, which is the 80 LA of the act. Deductions is 100%. Period 10 years. There are 2 subclauses there. 10 years in case of an entity of scheduled bank or foreign banks. It starts from the year in which they set up. Whereas with regard to unit of an IFSC, you have a bracket of 15 years, out of which you can choose which 10 years you want to apply. Nature of income, if you look at offshore banking units located in SEZ, business activities referred to in section 6(1) of Banking Regulations Act, all the financial operations. Approved business activity of any unit in IFSC. Transfer of asset, being aircraft or ship, leased by unit referred to in clause C. But commencement of operation should happen by 31st March 2030. Earlier it was 2024, which got extended to 2025. In budget 2025, they have extended this by 5 more years. Return of income, I have to specifically file along with the chart account stating the correctness of the claim. Unit is, I have to take reference from the SEZ Act. What is the meaning of aircraft or ship? Again, Schedule 6, Note 3, there they have given a definition. Aircraft includes helicopter or such other engine parts or other parts affiliated with an airplane or a helicopter. Ship includes vessels as and their engine parts. So this is just a summary of Schedule 4, where you have interest from NRE account has been provided here, and short stay exemption in respect of employees of a foreign company visits India. If his period of stay is less than 90 days and that interest is not deductible in the hands of Indian company, then or a deduction in the hands of a foreign company, then to the extent short stay will apply. So I have just given a comparative here with regard to what is the existing provisions exemption, how it is being replaced in the relevant schedules. Likewise, royalty or FTS received by a foreign company, if it is pursuant to an agreement notified by the central government which is relating to the security of India, then to the extent you will get a reduction with regard to royalty and FTS. Item number 2 is nothing but the consulate embassy related people, if they draw any salary, then under the Vienna Convention of Secular and Embassy related provisions, they are granted an exemption. So the same exemption has been codified here under section 10. Critical aspect, if you look at this serial number line, lease rentals from cruise ship. If a foreign company were to lease out this cruise ship to another foreign company for having an operations in India, then anyway that Indian company will pay taxes under percentage basis. Apart from that, whatever the lease rentals that foreign company pays to the owner of the cruise ship will also be exempted. So they have given a cut-off date of what is the outlier period up to which this exemption is available. It is available up to March 2030. This is just a summary of what we saw with regard to securitization trust, business trust, AAF and other things, how the exemption has been flowing from which provision to where. An important aspect is dividend and serial number 7, dividend interest and other income of 92K with regard to sovereign wealth funds, pension funds, wholly owned subsidiary of Abu Dhabi International Authority, and then the wholly owned subsidiary of Saudi government. If their government entity has invested in India with regard to any of the funds, and they are given a cut-off date, investment should have been made between this particular period, and they should have held this investment for a period of 3 years. That is the criteria they are given for exemptions. Clause 6, Schedule 6, if you look at, more to do with IFSC related regulations. Whatever I have covered there, I have just put it, summarized it in the form of a table, and I have given a comparative sections. So I'm not covering any provisions on GAR or transfer pricing. It will be covered in the subsequent section. That's it from my side. If there are any questions, happy to.
So this section 59, erstwhile section 115A. So
There it was told that royalty or FTS will be taxable only if it is connected to PE or fixed place of business. But such kind of, because if it is connected to PE or fixed place of business, it is very narrow. Such kind of definition is not there in erstwhile Act.
So erstwhile Act, if you look at 44DA, is what the current 59. In 44DA, there is a specific definition that has been referred to section 9, which is not there in 59. Because anyway, the language they have used is royalty or FTS. So you can very well go back to refer. Earlier, there was an issue with regard to the interpretation that explanation 2 alone was referred as royalty. Then subsequently, by virtue of explanation 3, 4, 5, 6, royalty got expanded. So this issue came up in the context of 40A1, where in one of the tribunal case, with regard to copyright taxation, the company has not deducted the TDS. In 40A1, if you look at the current 40A1, you see it only refers to royalty as per explanation. Now explanation 3 and 4 talks about computer software. So therefore the tribunal said that explanation 3 and 4 is never covered in 40A1. So therefore disallowance cannot be made. That kind of an issue possibly may come. But now if you look at the way the royalty definition has done, now there is no longer explanation or something. So you go look at section 9, I think subsection 6 still talks about royalty. All your explanation 3, 4 cover as part of a subclause. So therefore the interpretation issue now will come whether that particular subclause is giving a meaning or it is expansive.
Which section should be referring the new act for corresponding 115A?
207. 207 there is a reference to section 9. It is not there in section 59, which is 44DA of the Western law.
And also P is generally not defined in domestic law because the concept of
P, if you look at it, is defined only for the purpose of limited purpose in transfer pricing charter. So therefore, if you look at the Supreme Court in Morgan Stanley, there a service fee should be covered as part of 92F or not as subject matter of this discussion, where the court said it could also include service fee under the ambit of 92F itself. So you will borrow the treaty there because the nexus of P is much wider or much narrower compared to your SC. So the moment you have an operations in India in the form of a branch, possibly a question where in case of royalty whether the branch may own IP or not is a question. But it is possible in case of FTS, branch may render some technical services. There you may get covered. You can argue it is effectively connected.
One last question with respect to in general DDW interpretation, whether it should be considered comprehensive agreements or MLA, synthesized text. So, in general, for giving opinions to clients or giving advice, so should we consider synthesized text if there is any controversy between DDW and synthesized text?
See, if you look at OECD, the base documents, they have said synthesized text is only for the purpose of guidelines. It does not have any authoritative or binding in nature. If you look at the top of each of the synthesized text, that has been issued by India, it says it has been issued in consultation with the other counterpart. But there are certain differences in or mismatches in the synthesized text itself. For example, you look at the synthesized text of France and India with regard to Article 8 of MLA. There is an issue because under the existing treaty of India-France, there is an exception that has been given in case of immovable property, capital gains, where the company derives value significantly from an immovable property. If that immovable property consists of, let's say, your commercial property, where you have your operations, then exception is there under the existing treaty. But if you look at the notification by India, that exception has been removed now. Whereas if you look at the synthesized text notified by France, that exception still continues. Same in the case of UK. The manner of notification or a synthesized text, the positioning of principal purposes, they have put it in Article 28A in India-UK treaty. Whereas if you look at India-UK, they have put it in each of the Article 10, 11 and 12 because there is an issue in interpretations there. So there is a lot of mismatch in the synthesized text between two countries. So that is only for the purpose of guidance. It is your own aspect. You have to look at the final notifications of the respective countries to arrive at a conclusion.
So for issuing legal opinions, we can use comprehensive agreements.
So comprehensive agreement plus MLA notifications you have to see. While you may look at this recent Mumbai and Delhi tribunal where the position of MLA itself hanging in balance with regard to the way in which it has to be integrated with the law. But be that as it may, you will never know. The High Court may overrule that particular provision because one set of people believe that you don't need a separate notification because the Nestle ruling was entered in the context of a bilateral treaty, whereas multilateral treaty is slightly different. You look at the earlier SARC agreement, there was one single notification. So there is a divergence in the scholars still on this. But as a practitioner, let's say if someone comes to an opinion on a GAR or a PPT, will you say MLA will not apply, so therefore no need to look at PPT, which to my mind will be a hyper-aggressive position.
Thank you.
Thank you. Thank you. Thanks to the branch for giving this.
Dear member, Namaste, good evening. One announcement on 28th November, we have one day seminar on peer review at Bangalore branch in the same auditorium. To become a peer reviewer, you kindly register for the program. After registering the program, there will be a one exam conducted, and after passing that exam, you can act as a peer reviewer. On behalf of Bangalore branch and managing committee member and the member present here, I extend my heartfelt gratitude to CA K. PRASANNA sir for delivering an insightful and highly informative session on non-residence taxation under the New Income Tax Act 2025. We sincerely appreciate the time, efforts and dedication you have invested in sharing your expertise with us today, sir. Now may I call upon C.A. Chandraprakash Jain sir to kindly present a memento to the speaker as a respect and gratitude. Thank you, sir. Members, once again we thank you all. Good night.